good evening, or good morning, everyone. Thank you once again for your interest in Algonquin and for supporting us on our continued journey towards a pure-play regulated utility. I'd like to start with a quick review of how far we've come in our strategic transition. But first, I want to welcome Sarah McDonald, our Chief Transformation Officer, to the call. Welcome, Sarah. In 2023, we made the strategic decision to simplify and focus the business as a core regulated utility. It was and continues to be our belief that separating the regulated and renewables platforms would, after a transition period, allow both businesses to be more ideally capitalized and ultimately lead to longer-term growth and value. We began to streamline our capital structure early for this year. This started with paying off our margin loan with Atlantica and collapsing our development joint venture this past winter, and successfully remarketing our green equity units this past spring. In May of this year, we announced our support for Atlantica's strategic sale agreement, which is now expected to close on December 12, 2024. In August, we announced an agreement to sell our renewables business, excluding the hydro fleet, for up to $2.5 billion, representing an attractive valuation for our platform. This transaction is expected to close in the fourth quarter of 2024 or the first quarter of 2025. These changes are a considerable evolution for the business, and upon close of renewables and Atlantica transactions, we will effectively be a regulated utility business with significantly reduced complexity. As we've mentioned in the past, we will be looking to monetize our hydro fleet as part of the separation transaction. We continue to focus our efforts on successfully closing the renewables transaction, and as such, we have not yet officially launched the process for hydro. We would expect to begin the sale process sometime in the first half of 2025 once the renewables transaction is closed. It's important to note that the hydro business represents an annual EBITDA run rate of approximately $25 million, and we intend to only enter into a transaction if it creates value for our shareholders. At the end of the day, we're confident in the actions we're taking to position the business to deliver customer value and growth through simplification and focus. While the journey at times has been challenging, I'm excited to lead the company through this transition period to brighter days ahead. While we've been executing our strategic simplification plan, we've also been busy optimizing the core regulated business. When I started as CEO, I highlighted that one of my main priorities was to get the regulated business up and running. Early in the company's history, the business primarily grew in a piecemeal fashion. Our opportunity is to more effectively standardize and apply best practices to create additional value for our customers and shareholders. Despite near-term challenges, I'm confident we're taking the right steps. First, we completed the rollout of our customer-first SAP-based IT platform in the spring. We're in the typical stage where we're adapting to our new system and our processes. We recently rolled out the next phase of business services, which will help simplify and harmonize customer service and back-office processes, leveraging our new platform. These key milestones in our transition to a more focused regulated utility business. Although our system implementation has caused some short-term regulatory lag and has in part impacted the timing of rate cases, we are excited by the longer-term potential these steps will provide. Second, we're evaluating our regulated utility infrastructure expertise, and we've just added, in the last few quarters, new members to our board and new executive leadership, all of which have extensive regulated experience. Third, we're reorganizing our utility structure to group by commodity to drive best practices throughout our network. We have revamped a number of our internal processes in an effort to drive more consistent results. These approaches are approaches that I've successfully used in the past, and I'm beginning to see positive change and increased accountability within the organization. To be clear, this is a journey, but we're heading in the right direction. Looking ahead, one of our main priorities is to recover and earn a return on capital that we've already invested, but have not yet captured in authorized rates. There are 3 large rate cases that we expect to improve our return on capital. I'm pleased to say that we recently filed rate cases for Empire Electric in Missouri and CalPeco in California, and expect to file Litchfield Park in Arizona in the first half of 2025. The general rate case for Empire Electric Missouri was filed yesterday and includes a request to increase rate base by approximately $534 million. The filing includes a 53.1% equity layer and 10% allowed return on equity, resulting in a requested revenue requirement increase of approximately $92.1 million. Historically, Empire's electric rate cases take about 1 year to resolve. CalPeco's general rate case was filed in September and includes a request to increase rate base by approximately $154 million through 2025. The filing is based on a 52.5% equity layer and 11% allowed return on equity, resulting in a requested revenue requirement increase of approximately $39.8 million. Based on typical timing, we would expect this rate case to be resolved sometime in the first half of 2026. Concurrent with the rate case, we filed a request to adjust rates retroactively. We're aiming to file a rate case at the Litchfield Water and Sewer Facility in Arizona in the first half of 2025. As we indicated on prior calls, the Saraville wastewater plant is a substantial investment in the community, and it serves significant manufacturing development along a key corridor in the greater Phoenix area. The plant itself represents approximately $108 million in investment, offset by approximately $23 million in connection fees. This results in our seeking approval to increase rate base by approximately $85 million. Historically, Arizona rate cases can take up to 18 months to complete, so we expect financial benefit from the rate case to start in 2026. These 3 rate cases constitute over $700 million in potential net increases in our authorized rate base. As we turn to 2025, it will be the first year we will be in a position to focus completely on our regulated business. As I mentioned on our last call, there's no question that our short-term results will be impacted by the timing of rate cases. On the other hand, we are taking the right steps, and I'm confident that we have a tremendous opportunity to improve our rate case outcomes, leverage our IT platform, and run the business more effectively. The filings of Empire and CalPeco, along with other actions I've described, are positioning us well to increase our momentum beyond 2025. And with that, I'll ask Darren to review this quarter's operational and financial results. Darren?
Thank you, Chris, and good morning, everyone. I'll start off my commentary today with an overview of key rate case developments. During the third quarter, we received the final order for our New York water utility, authorizing a $38.6 million increase in revenues over a 3-year rate plan, which came into effect on September 1st. As highlighted by Chris, in the third quarter, the company filed an application at our CalPeco electric utility in California, seeking an increase in revenues of $39.8 million based on an ROE of 11% and an equity ratio of 52.5%. We also recently filed an application at our Empire Electric Missouri utility, seeking a revenue increase of approximately $92 million based on an ROE of 10% and an equity ratio of 53.1%. As we look forward, we plan to file rate cases at Litchfield Water and Sewer, New England Gas, St. Lawrence Gas in either the fourth quarter of 2024 or the first half of 2025. As we have mentioned on prior calls, 2024 represents the largest number of concurrent rate cases in the company's history. At this time, the company has pending 13 rate reviews, which represent approximately $205 million in revenue requests. Turning now to financial results. This quarter, we separated our results into continuing operations and discontinued operations. Let me provide further color to help you better understand the moving parts. Our continuing operations includes our regulated business, hydro business, and ownership stake in Atlantica. It also includes all debt except debt specific to our renewables business. We continue to record our ownership stake in Atlantica and associate dividends in continuing operations based on the application of generally accepted accounting principles. We now expect Atlantica to close on December 12, 2024. Our discontinued operations includes our non-hydro renewables business, including taxes and associated tax credits, and $1.25 billion in specific debt related to our renewables business. In terms of the numbers, our third quarter financial performance for continuing operations saw year-over-year growth in revenue and adjusted EBITDA of 1% and 4% respectively, primarily due to the implementation of new rates across several of the regulated business electric, natural gas, and water facilities. Our revenue growth was partially offset by lower pass-through commodity costs. We recorded year-over-year decreases in adjusted net earnings and adjusted net earnings per share of 5% and 20% respectively. While our results benefited from new rates, they were more than offset by higher operating expenses as well as depreciation and interest expense. Adjusted net earnings per share was also negatively impacted by the previously disclosed issuance of 76.9 million common shares in connection with the company's green equity units through a mandatory conversion back in June. On a segmented basis, adjusted EBITDA growth for the regulated business in the third quarter was up 3% year-over-year due to the implementation of new rates at several of the company's electric, gas, and water facilities, as well as higher HLBV income as a result of normalized wind resources and the recovery of securitized regulatory assets at Empire. These gains were partially offset by higher operating expenses as mentioned earlier. A few other comments on our balance sheet as we move closer towards closing our Atlantica and renewables transaction. Our Q3 balance sheet debt, including continued and discontinued operations, is $8.7 billion, which increased from Q2 in part from the buyout of a construction loan at Carvers Creek. We expect to have approximately $1.7 to $1.8 billion in net proceeds from the renewable sale after off-balance sheet construction loan obligations and other renewable liabilities are satisfied. Final net proceeds received may vary due to items such as construction spending variances, tax credit timing, and monetizations. It's worth noting, included in the $1.7 to $1.8 billion, we now expect to receive approximately $150 million of net proceeds associated with tax attributes in certain projects in late 2025. Let me have a few call-outs on our year-to-date earnings and some reminders for next year. Year-to-date, our continuing operations adjusted net earnings is $187 million, and our adjusted earnings per share for continuing operations is 25 cents. Included in that is $65 million in Atlantica dividends year-to-date, or approximately 9 cents in adjusted net earnings per share. So as you think about next year, there's a few pieces merit calling out. If you combine the proceeds of both transactions, ignoring timing, we would expect to receive $2.8 to $2.9 billion. As you consider our pro forma adjusted net earnings per share, you need to take into account that based on our Q3 balance sheet, $1.25 billion of proceeds would go towards discontinued operations debt paydown, leaving $1.55 billion to $1.65 billion for deleveraging against the continuing operations. So as you think about our pro forma continuing operations number, you would need to incorporate the continuing operations deleveraging and then remove the Atlantica dividends. As we've noted before, we are not providing 2025 guidance at this point. As a reminder, our results on a per-share basis will be affected by the full year effect of the settlement of our equity units from earlier this year. We plan to provide guidance when we report our fourth quarter results. In summary, we are on track to achieving a number of key milestones on our path to simplification and becoming a pure-play regulated business. This is a journey, and we are focused on taking the right steps to create long-term value.